So you should now be able to see my screen with a picture of me with a green shirt. Can you see that? Yes, yep. I guess so. Yeah, all right. So I run the Macro Compass, as Marty said. It's a macro investment strategy firm. Before that, I ran a $20 billion investment portfolio. That's for ING Bank. If you guys are not familiar, it's a global bank, mostly based in the Netherlands, but it's also in the US, in Australia. It's a global bank, really. I quit the job at the end of 2021 and started my own consulting firm, basically, that turned into an independent macro investment strategy firm. But enough about me, because that's boring. Let's talk about macro. Before we do that, I'd like to point you to one of my most important leading indicators. That's a series that I built and curate. It's the Global Credit Impulse series. Why would that matter in the first place? It's because that tells you whether real economy money is being printed or not. And we are in 2023, and there's a lot of misunderstanding about QE, QT, who prints money. The reality is that central banks can print money for banks, but fiscal deficits, handing over checks to people, cutting taxes, creating credit for the real economy. That's real economy money printing. That's money we can use. And this series tracks the impulse of creation of credit for the private sector, for households and corporates. It tells us whether we, private sector agents, are getting more money at hand or less money at hand. This indicator drives and tracks very well, with a leading time of 9 to 12 months, earnings per share growth, GDP growth, unemployment rate, inflation. And it makes sense. It makes sense because the more money you create and you give people to spend, the more, with the time lag, they'll spend it. They'll boost nominal spending. They'll boost growth. Inflation will go up. And that's what we have seen here. You see this very large spike up in 2021. This is when all governments in the world and all banks, basically, globally speaking, were giving credit, cutting taxes, giving stimulus to people. They were doing that all at once. This was the fastest ever amount of credit being created. Money handed over to people. And then we saw the economy growing very fast in 2021 and at the beginning of 2022. But look at what happened after. What happened after is the fastest credit cliff that we have ever seen over the last 25 years. That's because the government has stopped printing money, guys. You haven't received any check in your mailbox after April 2021. No tax cuts, no proper credit creation from the banking system, especially adjusted for inflation. And so you get this slowdown in credit creation. You get a cliff. After every sugar rush, there is always a cliff. And look at every time we had a cliff in credit creation, what happened. 2008, 2009, earnings per share in the S&P 500, 12 months later, that's the power of this leading series. It leads earnings per share growth. Earnings dropped by 30%. In 2015, the Chinese hard landing, the leverage story, earnings dropped by 5%. In 2019, we also stopped creating credit in 2018. And all of a sudden, in 2019, earnings were 0% in the S&P 500. We never had such a tough, hard cliff. And that actually, looking ahead, calls for an earnings slowdown of at least 10 to 20% on a year-on-year basis. And when earnings drop 10 to 20%, that's also called a recession, in other words. That's the backdrop from a growth perspective that is confirmed from many other leading indicators that I use and track. This is the Conference Board Top 10 Leading Indicator Index, the orange line here. Has a 50-year plus history and a perfect track record in anticipating every recession over the last 50 years with an average lead time of 7 to 8 months, when this indicator printed negative for 2 months in a row, at least 2 months in a row. Look at where it is today. That's the red box. An index of leading indicators in the US has not only printed negative for 2 months in a row, but it's dropping pretty aggressively and in line with the recession we have seen in the 90s or in 2001, for instance. According to these indicators and to the global credit impulse, you should start seeing a recession in the US roughly around May, June this year. And a recession means people lose their job, earnings go down. That's the backdrop for growth ahead of us. We have dried up credit creation in the economy completely. We have tightened up the belt. We have tightened up financial conditions. The inevitable result is a recession. And the timeline is roughly mid of this year. The only thing that is really holding the US from being already in a recession is the labor market. And on the labor market, I have two comments. The first is it's just a matter of time. And the Federal Reserve actually wants a weaker labor market. In my career, I have never, ever experienced a central bank that has in their own forecast unemployment rate to be 1 full percentage point higher in a year from now. There is a rule that an economist developed at the Fed, the SAM rule, it's called. Claudia Sam discovered that every time US unemployment rate moves up 50 basis points from their lows, the US is already in a recession. The Federal Reserve is basically forecasting unemployment rate to move 100 basis points higher. They want it to be 100 basis points higher, which means the Federal Reserve is effectively trying to engineer a recession. They can't say it out loud, but that's what it is right here. Unemployment rate, though, the orange line is still at 3.4%. I inverted it on the right end of this chart. So it's still extremely low by any historical standards. What's this blue line? It looks to lead the orange line very well. You can see in 2000, when the blue line went down, the unemployment rate went up. Remember, this series is inverted. So when the orange line goes down, the unemployment rate is going up. You see in 2007, 2008, blue line down, unemployment rate also moves. And also on the way up, it leads unemployment rate. This blue series is the National Association of Home Builders Housing Index. It measures housing activity, basically, in the US. And can you have a look at how materially it dropped from the peak housing, let's say, strong sentiment of 2021? It really dropped materially. So with a lag, normally an employment rate in the US should also drop pretty materially. And why? Because when the housing market freezes this rapidly, and when mortgage rates are 6.5%, 7% for a prolonged period of time, and Americans can't afford to really push the housing market as hard as they did in 2021, construction employment goes down. Any employment related to the housing market, even ancillary activities, brokers, financials, et cetera, they all go down. Why is this important? Because the labor market around the housing market represents roughly 16 to 70% of the overall employment in the US. And right now we are in labor hoarding mode. We have companies that are not actively firing people, even in the construction business, because they have experienced how hard it is to hire somebody during a pandemic. So with that fresh memory, they're trying their best to hoard labor. But if the housing market keeps being this weak, it's just a matter of time until layoffs will happen in anything related to the housing market, and therefore will drag unemployment rate higher. By the way, when you hear about the US labor market being very hot, actually, let's look into the nuances of the labor market for a second. A hot labor market, it's something like mid-2017, mid-2018, or 2022, during the reopening, boosted by fiscal stimulus. You see this orange series? That's the full-time workers being hired by US companies on a 6-month rate of change annualized. So this is how many full-time staff US companies are hiring on a trending basis. When the labor market is very strong, this number is anywhere between 4 and 7% annualized. Guess what the number is today? 0%. No full-time workers being hired on a 6-month rate of change annualized. No full-time workers being hired. So effectively what we're seeing right now is a labor market that is not yet in recessionary mode, not at all. It's though freezing pretty rapidly. And the labor hoarding from companies that is the result of their experience during the pandemic is holding off the labor market from dropping materially. You give it another 4 to 5 months of Fed funds rate at 5.5%, of tight financial conditions, of a market that can't pick up because mortgage rates remain very high, and the housing market is ultimately going to fall. And the labor market is ultimately going to feel the pinch as well. One way to visualize that is that there are leading indicators and lagging indicators in the macroeconomic cycle. So here what I did is I put at 0 the highs of each of these indicators in the last cycle, and then I plotted them according to their development thereafter. So one of the leading indicators, as I said before, is housing. And year-on-year housing sales have topped in May 2021, and they have dropped by roughly 40 to 50% in the US. Guess what happens 6 months later? New orders in the PMI service, both in the services and in the manufacturing sector, start dropping pretty materially. And new orders have dropped by 8 points since their top in November 2021. Guess what happens after that? The momentum of hiring starts slowing down. The peak in the momentum of non-farm payrolls on a monthly basis was in February 2022, a year ago. Since then, the labor market has kept hiring on a net basis, but not as strong as it was before. So also there you get a slowdown in momentum of hiring. And now give it another 6 to 9 months. And what happens is that also core inflation will slow down. Earnings will go down, GDP will go down, core inflation will go down. These indicators are the most lagging one in the cycle, and that's where they are all moving. Now, the problem compared to the past cycles was that every time inflation started moving down, the Federal Reserve could immediately accommodate conditions. The starting point for inflation this time is totally different. We have core inflation in the US almost at 6% even today. So it doesn't take a few percentage points for the Federal Reserve to feel comfortable and come to the rescue so that all these indicators can rebound. This is not going to happen until inflation moves all the way down to 2%. So let's see where we stand on the inflation front, shall we? We have heard from Chair Powell that they look at inflation, splitting it into 3 main categories: goods, housing, services ex housing. This might not be the best way to look at inflation, but who cares? They set monetary policy, they tell us how to look at it. So let's look at it how they look at it, right? Goods. Goods inflation was prevalent in 2020. Everybody was locked home, supply chains problems, stimulus. We bought 3 laptops each, 4 pieces of furniture. Goods prices went up. They have now decelerated very rapidly. The Fed knows that. Do they care that much about that trend? Yeah, not really. They acknowledge it, let's say. Housing inflation. Yeah, this is what you see in this chart. This bothers the Fed, but the Fed is smart enough to understand that. You see the bottom chart here? This is shelter inflation year on year in the US as calculated in the CPI. And it's now running at 8% annualized. Holy crap. But the issue is housing inflation in the CPI, because of calculation methodologies, literally lags what really happens on the ground. And what happens on the ground is shown in this upper side of the chart. This is the Redfin year-on-year asking rents index. Rents on the ground, negotiated rents, were up 18% up until March 2022. But what happened after that is that they declined materially because the housing market is freezing. It's very simple. So as the housing market slows down, rents tend to slow down as well with a lag. Right now, rents have only increased year on year from Jan 23 to Jan 22 by 2%. This measure, housing CPI inflation, follows with a lag what happens on the ground by roughly 9 to 12 months, which means we are round about seeing the peak of housing inflation in the CPI. Housing inflation will slow down. The Fed knows that. They have incorporated that in their projections already. So if this trend materializes and core goods remain in this disinflationary trend that the Fed is looking at, inflation should converge down. But the most important indicator of all to really assess whether sticky inflation is coming down is the third category, which I hear called Powell's CPI, because that's really what he cares the most about. Services ex housing. So I looked at it on a 3-month and 6-month annualized basis, because that's what Powell does. So I'm nobody to actually go against him. On a CPI basis, services ex housing, 3-month annualized, are running at 5%. The Fed, though, doesn't target CPI, they target PCE. And PCE, services ex housing, on a 6-month annualized basis, to smooth out a bit more the series, it's running at 4% annualized, double the Fed target, no progress over the last 9 months. So where do we sit today? Today, we sit in an environment where growth has clearly come off. The labor market is holding off somehow. Leading indicators are telling us, though, that this is not going to last, and that the recession is likely to hit the US somewhere around mid this year. But there is this period between now and, let's say, June, when it always looks like a soft landing at the beginning because growth hasn't slowed down hard enough. Do you remember Q4 2007? The IMF, the Federal Reserve, JP Morgan, they all come out with reports calling soft landing. Why? Because at every slowdown, it always looks like a soft landing at first. But if you do the work, at least according to my leading indicators, a recession is about to happen. This transition period, though, where the economy isn't yet in a recession and core inflation is relatively sticky for the time being, makes it so that the Fed is going to keep policy super tight and effectively choke the economy and make sure that we really have this recession. So let's have a look at the bond market and the equity market for a minute. The bond market is basically saying the following. Okay, so we are going to cut away any interest rate cuts being priced from June to December this year, because the Fed is going to keep rates at 5.25%. They're not going to cut. We have to reprice this away. But this means that Fed funds rate at over 5% are going to be prevalent for an entire year. These conditions are going to be tight for a very long period of time, which actually increases the chance of a recession later on, which is reflected from the fact that yield curves are inverting further and further and further. So that's what the bond market thinks. What about the equity market? Let me make the case that the equity market today at 4,100 is more expensive than the equity market at 4,800 in January 2022. It sounds crazy, but if you bear with me for a second, look, you see the red dotted line here. The red dotted line is the end, let's say beginning of 2022. The green dotted line, sorry. What you see here is real interest rates in the US on the left-hand side in blue against valuations on the equity market, orange on the right, inverted, and high yield spreads, high yield credit spreads in yellow. The relationship is very tight for very good reasons. When real interest rates are very low, like they were in the end of 2021 or beginning of 2022, there is no alternative. If you have negative real interest rates, you are doing two things. You're pushing all these institutions in finding some sort of carry into high yield credit spreads, for example. You're really forcing them there because by buying treasuries, they get nothing. They get negative real rates. And on top of it, these negative risk-free real rates are used to discount future cash flows in the equity space. So you're using a lower discounting rate, you're increasing the valuations of this equity market, which makes this orange line go down because remember, these are valuations inverted. So the lower real yields, the higher valuations, which means the orange line goes down. And this is where you were in the beginning of 2022. Now let's look at where you are today. You have the S&P at 4,100. I'm not going to make any assumptions on earnings, okay? So I think they are still pretty optimistic from an analyst perspective, but let's leave them aside. Let's just talk about valuations, credit spreads, and real yields. Today, there is a freaking alternative. Yes, there is. You can park your money at 5% in T-bills, and even if you want to buy long-dated treasuries, you get positive real yields to the tune of almost 100 basis points. Can you see the blue line here? If this correlation would hold, and it should hold for macro reasons in the medium term, you should have high yield credit spreads, not at 440 basis points, but right here at 550. And especially the valuations of the equity market shouldn't be 18.5 PE. It should be roughly 16.5 PE. So make your S&P 500 target, looking at earnings and multiply by 16.5. And you're going to be looking at S&P at 4,100. That is pretty expensive. And this is before you adjust for earnings that in my base case are going to disappoint market expectations. This is for the medium term. For the short term, before I close the presentation, at the Macro Compass, I use options to try and understand what is the prevalent market regime being priced in. So I look at the bond market, the equity market, and the FX market. I look at the option implied markets underneath, and I try to derive what are the market implied probabilities of a recession, a soft landing, or a higher for longer, strong growth environment. What the market is doing right now is it's feeling pretty comfortable about the soft landing. It's a 65–70% modal outcome being priced across asset classes. The recessionary tail on the left is being squeezed away further and further because short-term data is invalidating the idea that we're going to have a recession tomorrow. The right tail is becoming fatter because higher for longer is becoming a bigger risk. That's what the market sits today. If you look at these probabilities, I think the left tail, the recessionary tails, is now getting too much underpriced. The soft landing, the body of this distribution is way too fat. The economy and markets in 2023 and 2024 will be a reflection of how tight monetary policy was in 2022 and in the beginning of 2023. The same goes for fiscal policy. It has worked on the way up, going back to the first chart, where credit was given away in very large amounts, financial conditions were extremely loose. It worked in 2021, predicting strong economic growth and reflecting strong markets as well until the first half of 2022. This is the picture as per the end of 2022 that should reflect into markets in 2023 and 2024. Unless you want to go for the four most expensive words in finance, this time is different, then I would suggest that this tail, especially this center part of the distribution, that this inflationary fairy tale soft landing pricing is getting a bit overdone right here with the medium-term horizon. The left tail, the recessionary tail, should be priced a bit further. Most particularly, today you have an alternative, which is you are paid to be patient. Sitting on cash is generally considered like an option because it gives you the option to really, assess market opportunities from the outside, from the sidelines. Normally, be long options, you have to pay premium for that. Today, instead, you are paid a 5% nominal rate to sit on defensive positions while animal spirits come back, animal spirits that are basically contrary to what the Fed is trying to achieve. So the two main quotes that my mentor taught me to really iron in my brain are, this time is not different and don't fight the Fed. And I think I am going to, before I stop and give you guys the floor for questions or comments in case you have, just want to highlight that this is an excerpt of the many, many macro pieces that I write for clients, hedge funds, family offices, many of those at the Macro Compass. This is just an excerpt of that. You can basically see here the offers that I have for institutional clients. It's basically independent, institutional, actionable macro research at a fraction of a cost, I think, of what you would pay with investment banks. If you like these presentations, I thought with the blessing of Marty and the organizers to provide you with a discount code on annual subscriptions. So you can just, if you want, go on the QR code, put up the discount code NYC, and the first 10 subscribers are going to get 20% off on annual subscriptions. Now, I'm going to leave it up for questions, guys, on the floor, in case you have any or comments.
Folks, do we have any questions out here about the general economic outlook? Yeah. David?
It's an interesting game, the forecasting of the economy and everything, the macro forecasting. But my question is, let's say a soft landing that starts later this year, but it's temporary until the wage inflation comes down a lot, until you get to your 2% overall inflation. And then the unemployment rate shoots up. What are the odds of something of this type of scenario?
So Alfonso, did you hear that? It's what happens if there's a soft landing for a while and then wage inflation declines because of the 2% target is hit, and then it becomes a little bit harder. What is that scenario possible?
So that is basically the scenario being priced in by bond markets today that I want to stress are not pricing a recession. I don't know how many times I heard it from clients, but no, guys. In a recession, the Federal Reserve cuts rates historically by 350 basis points in the first 18 months following the start of a recession, sometimes 400 basis points. What the bond market is pricing now is a peak Fed funds at 525, and then roughly 200 basis point, 250 basis point of cuts back to somewhere neutral interest rates, 3% area. If there is a recession, the Fed doesn't cut rates to neutral. The Fed has to cut rates way below that. In 2001, with the recession, the Fed cuts rates from 5% to 1.5% in the span of 15 months. Those are recessionary cuts. Those are not priced in by markets. So what the bond market is pricing right now is that inflation drops like a stone, which is basically the outcome highlighted by the question. Inflation swap markets are pricing inflation to be at 2.5% by September. 2.5%. We are right now over 6.5%. So the bond market is pricing this inflationary soft landing. The bond market is assuming that is the case. The equity market and the credit markets are going one step further, assuming not only it's a inflationary soft landing, but we also avoid a hard recession, and growth, if anything, is rebounding, especially in what's being priced in credit spreads, with a default cycle, a very shallow default cycle being priced in, cyclicals outperforming. So the answer is, do I expect that to be the base case? No, I don't expect that. Does the market expect that to be the base case? Yes, definitely so. So this might be the prevalent market narrative for another 2 to 3 months. But if you're managing medium-term money, this would really be one of the cases where this time is different, where we have dried up credit, we have tightened monetary policy super aggressively, and we can engineer a soft landing. It has basically never happened with this amount of credit cliff and tightening of monetary conditions.
We have another question, Alfonso. John?
Alfonso, to what extent do you think the Fed is taking into account some very important influences on labor supply? And those are, one, post the pandemic, which of course created much of the credit inflation. Post the pandemic, there's a large component of long COVID now in the population, which has decreased the availability of able labor. And also, to a lesser extent, but nonetheless significant, there's a growing evidence that vaccine policies have also caused harms, not widely, but significantly. And these also add to the tightening supply of able labor, especially in young men, you know, with cardiac problems, etc. So I and some other economists. I'm not an economist, but I'm a doctor. A friend of mine, David Kotok, who has presented at this conference before, is pointing out the influence certainly of long COVID. I add to that the harms from the vaccines in a part of the population, and that the Fed is in danger, therefore, of misjudging the labor situation and overshooting on its tightening.
So Alfonso, error in measurement of employment from the Fed based on long COVID and vaccine?
This is an excellent question. There are roughly 1.5 million Americans that seem to have disappeared from the labor force in the first place. The number used to be bigger, but actually the Census Bureau adjustment, the population adjustment that we have seen in the non-farm payroll numbers of January has cleared up some of that missing population. Roughly 700,000 have been found all of a sudden. That tells you something about the statistical accuracies of this labor market print. So you always have to look at a broad range. It's not that one labor market indicator. Broadly speaking, though, it is true that because of long COVID and because of the fact that many people during the pandemic had their investment portfolios recording profits that were so large that they could literally decide to just monetize that and retire, especially in the 55, 65 years cohort, the labor supply has diminished in the US. And that is a stagflationary driver, because people like to focus on the inflationary part of it. And that is correct. If you have less available labor in certain areas, you're going to have more wage pressures. But less available labor means your labor force is smaller, which means these people have retired. They don't contribute anymore actively to economic growth like before, which means long-term potential growth also moves lower. So that's a stagflationary development that the Federal Reserve, I think, is going to be facing like it faces anything else at this point. Objective number 1, 2, and 3 are bring inflation down to 2% as fast as you can. If labor supply is a problem, then we need to destroy demand even further. So unfortunately, the Fed has basically one big hammer, which is monetary policy, and they can just slam it on the table. And sometimes it's not the best instrument to use, but do they have a choice? They're facing credibility issues right now. So if the problem is labor supply, it is a stagflationary problem. They're going to apply this, the only tool they have, which is this big hammer of raising interest rates and having as weak of a demand as you can be until layoffs happen and the labor market is more balanced again.
There was another question. I'm sorry, one more question? And this is the last question.
So just in response to that, this vast amount of wealth that was created, does that not go back directly and indirectly into the economy in the form of the investments that that wealth makes, that 50 to 60 wealth that you speak of, whether that's in mom and pop, whether that's in real estate, all the income that's generated, the taxes, the workload relating to that real estate, as well as on the other end of the barbell, the newbie, the startups, and all the next generation of whatever it's going to be. So that's the first part of the question. The other part is a 2% not an entire misnomer relevant to what's norm? Why is the Fed stuck on this idea of 2%? Why is it not 3.5% or 4%? Why is 2 the proverbial normal or what makes sense, particularly in light of what's potentially a forever changed world? And you can go into a whole litany and reasons of why and how, but personally, I feel it is a changed world, and therefore the 2% is BS.
All right, let me tackle the 2 questions quickly, one by one. So, oh, I actually forgot the first one, so I'm going to reply to the second, if you don't mind. I'm sorry.
So bad, the question was so bad.
The first one was what happened to all the money that was dropped on
Oh,
the
yeah. Okay. So what happened to all the money? So you need to understand
how is that not accretive to growth? How is all that money not accretive to growth?
Yeah.
Passive, directly or indirectly. All that wealth, because they're not just, it's not all sitting in 5% treasuries.
That's true. So look, when the government spends more than they intend to tax it for, so literally it lowers taxes, it sends checks at home to people, it does fiscal deficits, it literally increases the wealth of the private sector. That's what happens. They cut taxes, they blow a hole in their balance sheet, you're now richer. That's literally what happens. That's undeniable. And the same when banks do credit creation. So when you don't have money to buy a house, you go to a bank, the bank credits your bank account with a mortgage, and all of a sudden you have the money to buy a house. Magic. It's credit creation. You're going to repay that loan slowly, but surely it destroy that credit. Now, what we have done in 2021 is to create a lot of real economy money all at once. The impulse effect of that has already been there, because on a rate of change basis, earnings grew by over 50% on a year-on-year basis in 2021. Real GDP growth in the US was over 5% in 2021. So on a rate of change basis, you've already seen that. What happens to the stock of money being created? Well, the stock of money being created remains there. It doesn't disappear. So there is something to be said about the fact that our system works on an increasing continuous creation of new money, of new credit. It's the rate of change that matters the most. Our system literally demands us to create more money year after year, but it's the rate of change that makes a difference, that drives economic growth cycles. So the upswing cycle we have seen, the downswing cycle is now what follows after that, because the rate of change of money creation is now negative. On the inflation side, although I have to say, on money, I could speak for 5 hours. So I know this answer is not complete, but in case, again, feel free to go look at the services, and there is much more. There's going to be courses as well covering everything, research every week. So following the second question on the 2%, okay, that I can answer very clearly because I spoke to many central bankers because of my job in the past. I asked the same question, and they're like, okay, so 2%, it's far away from zero. relatively far from zero. Zero is the problem, or minus is the problem. It's called deflation. And in a debt-based world, in a credit-based world, if there is deflation, the money you owe becomes more valuable. Oh my God, you definitely don't want that. If your system is based on credit creation, you don't want the debt to be worth more when you need to repay it. So deflation is a problem. You want to be comfortably away from that, and 2% is considered comfortably away from that. Why not 3 or 4%? Well, I think that has to do a bit with psychology of people. So 2% is something that summed up. This was the old rule. 2% inflation target plus 2% real potential growth makes it 4%. 4% is a socially acceptable nominal growth figure. This was literally the answer I was given by 2 central bankers. Now you ask them, is this applicable today, where potential growth rate is unfortunately not 2% anymore because of demographics and productivity? Why is that 2% there? The answer is not that strong anymore, but one thing is very clear. Credibility is on the line. So you cannot move your goalpost right now. They will not move their goalpost unless they go back. They really achieve their target of inflation falling to 2%. The moment they achieve their target, they regain credibility. We can discuss about moving the goalpost, not before, because credibility is the only asset that the central bank really has. If they miss that, they're over. So they're never going to compromise on that. That I can tell you for sure.
Alfonso, there's a bunch of questions online, and if you can stick around and answer, that'd be great. Let me just move over 1 second here.
Marty, do you mean going through the questions one by one and answering them?
If you can just answer it, in text briefly, that'd be great. Or just point people to where on your website there might be an answer. So just real quickly, Alfonso, maybe you might want to take your presentation down.
Yeah, sure.
Your presentation, stop the screen share so we can talk to you. Great, perfect. Yeah. So lots of questions from the audience and from online. So a couple of things. You didn't really cover Europe. So getting back to the discussion of what expected growth is, a nominal 4%. And if you see the French population and the way they're getting very unhappy with just raising the retirement age from 62 to 60 or 60 to 62 or 60 to 64 years old, it's very fascinating. I mean, there's the game of running the central bank, but there's also the game of keeping the population happy, right? So you didn't really cover Europe, which I think is a fascinating topic, and we'd love to cover it sometime in the future. And likewise, you didn't also cover the topic of disengaging from China, which a lot of the West is doing, right? So that's why we have DARPA speaking and people like InQtel is because it's such an interesting topic. But I'm sure that actually impacts, deflationary pressures and things like that. Everything's getting more expensive.
It does, Marty. So I am European, so my strong Italian accent credentials make me so a credible European speaker. No, just kidding. But look, Europe is in a pretty tight spot, I think. There are 2 pillars of leverage that Europe used in an incredibly good way over the last 20 years. 2 sources of leverage. They work like a charm. The first was economic leverage. Germany imported the equivalent of 30 billion of Russian natural gas, 30 billion, that was it. And they generated over 2 trillion of manufacturing output. So there was a cheap energy leverage, a cheap commodity leverage. There was outsourcing of labor costs. There was on-time global supply chains. I mean, Europe is an exporter-oriented country. Germany is the largest economy, and it's really an export-oriented country. It could leverage incredibly well on cheap energy, cheap labor, outsourcing, global supply chains working perfectly on time. All of that is a bit challenged, I would say, right? If you are now a CEO, are you sure you want to do everything on time, global supply chains? Really didn't work well for car makers, for example, last year. Energy, not that cheap anymore, a bit more complicated. So this source of cheap leverage is very much compromised. Second one was low interest rates. I mean, we talk about the US, but European junk corporates could borrow at 3%, 3%. If I say this out loud, I can't believe it, but it's true. They borrowed at 3% for 7 years. Wow. Any business model works borrowing at 3% if you're a junk corporate. Anything works. Anything makes sense. So all of that is over. And also the housing market. I mean, I live in the Netherlands, guys. These guys have 200% mortgage debt to GDP. I want to repeat the figure. 200% private sector household mortgage debt percentage of GDP. Why? Well, credit is readily available in the Netherlands. Mortgage rates. When I bought my house, when I hear that, 30-year mortgage rates 1.8%. Fixed.
Don't sell.
Like, dude, everybody feels rich. Everybody can afford a house of $1 million if you pay nothing to borrow this money, right? Now go look at mortgage rates right now in Europe, 4.5%, 5%. I mean, this other source of leverage, cheap leverage, which is low interest rates, low borrowing cost, is over as well. Italy now pays over 5% to refinance their debt. I mean, guys, these sources of leverage are compromised, to say the least. So the European...
Great. I can't go on forever on this, but the other point observation I wanted to make, getting to your Germany point, was that my understanding was that Germany imported $40 to $50 billion worth of oil and natural gas from Russia, which created this $1 trillion of economic goods, right? And I think you pointed out that that the cheap energy isn't there anymore, number one. Number two, in the UK, more than 25% of the mortgages are floating rate.
Ouch.
So that's not a good thing. Exactly.
Ouch.
I think in the United States it's around in the US it's around 4 to 5%.
Yeah. So
right. Okay. So it's food for thought on the outlooks for those countries. So hopefully we can have you back, have you talk about a little bit, if you cover China, talk about China, talk about Europe. Those are topics of great interest to our group. So we'll talk offline about it. And again, if you want to post the link to where people can take advantage of your offer, your subscription rate is way too low. You must raise prices. That's I mean, it's ridiculous.
Well, look, Marty, not enough. 20% off, 20% off for the first 10 people. It's like my marketing guy is like, dude, come on, you're too cheap. But okay, I just want to try and convey a bit of macroeconomic expertise I've developed to as many people as I can. I'm going to post the link in the chat.
Great.